People overestimate in the short run a technology's disruption, but underestimate its potential in the long run.
How can you as a retail investor filter actionable, high quality information?
Go beyond kind of first level reading to what's called second level reading. Read the article and ask yourself, okay, what are the market implications of this thing?
In which part of the research process do you incorporate all this information?
The name of the game in investing is not to be correct 100% of the time, because that's impossible to achieve. The aim of the game is to be right more often than you're wrong, having a good investment process and sticking to it.
What will our role be in the financial industry like 5, 10, 20 years down the road?
For the vast majority of jobs, is going to be there as a tool to try to make you better and more efficient in your job. It's your intern.
What's one lesson that you've learned in your career?
People think we're these nerds that just construct Excel models all day, but there's a big aspect of communication.
What are the steps that our listeners should have in mind?
It's a very good question, because if you ask me, Ignacio, what's the secret to investing? And in my humble opinion, it's
This is The Blonde Dollar with Ignacio Ramirez. Hello everyone, welcome to this new episode of The Blonde Dollar. Today I'm super excited to have Reda Farran on the podcast. Reda has over 12 years of experience in the finance industry. He started as a sell-side analyst before moving into investment consultancy, helping institutional investors with portfolio allocation and optimization. After that, he spent 4 years at Fidelity as an equity analyst, researching stocks across different sectors, including grid energy and utilities, two sectors more relevant than ever today. And these days he's at Finimize, where he's focusing on empowering retail investors by simplifying financial concepts and helping them make smarter investment decisions. If you're trying to navigate financial markets via finance apps or different news outlets, there's a really good chance you've read some of his work or seen him in action, because he's a regular guest on Bloomberg and on CNBC, and he shares his insights on markets there. Beyond that, Reda is a very nice guy, and he's giving back to the community through his Invest in You Academy, mentoring students and helping the next generation of students to break into finance. Reda, welcome to the show. I can't wait to hear your story.
Ignacio, thank you so much for having me. I'm really excited to be here, and I'm looking forward to our discussion.
Yeah, me too. And what you guys don't know, like Reda is extra nice because we've just recorded like half an hour of conversation only to realize that it didn't go through. So we're starting over the whole thing. So Reda, I owe you a big one. Sorry about that. The tech sometimes plays against us. Okay, so let's go. So Reda, you work at Finimize, and of course, a lot of the conversation today is going to turn around retail investors and the whole democratization of finance. So to start things off, I'd like to ask you, what is it that you folks are doing at Finimize, and what is the democratization of finance exactly?
Yeah, I mean, it's a very good question. So look, I think if you look historically at the finance industry and the private wealth management industry and the investing industry, historically, a lot of kind of smaller retail individuals have been kind of left out of that, okay? A lot of it has been tailored to wealthy individuals who can, afford a private wealth manager simply because they had a high enough net wealth. Now, what we're trying to do at Finimize is basically trying to, kind of get rid of all of that and say, look, it doesn't matter if you're a small or a big investor, and particularly if you're a small investor that's going to be overlooked by the private wealth management industry because, you don't have a high enough net worth and you cannot go and afford to get your own private wealth manager. Okay, we are going to empower you to become your own wealth advisor, your own financial advisor. So we're going to empower you with the right kind of mindset, knowledge, and toolkits to basically take your own investment decisions. And you no longer have to go and rely on a private wealth manager, especially if you don't meet their very high threshold of net worth before they even kind of consider taking you on.
And so obviously this democratization of finance has empowered a lot of retail investors, but there's a lot of concerns about the quality of the information they consume, right? Because they're looking at social media, at newsletters, at different finance influencers. So how can you as a retail investor filter really the noise from what is truly reliable and actionable high quality information?
Yeah, and I think what's really also interesting embedded in that question is just how much access to information has shifted over time in the investment industry. So if you looked a few decades ago before the advent of the internet and so on, even professional equity analysts were searching for some kind of informational edge to take investment decisions, which could have ended up leading to kind of strong investment returns. You hear about these anecdotes of professional equity analysts kind of sitting outside Macy's over Christmas, keeping a tally of, customers going in and out, trying to figure out if Macy's was going to have a good quarter, a very essential quarter during the holiday season or not. So they were trying to capture some kind of informational edge and base investment decisions off that, which back in the day when, information was not as freely available, that actually gave investors an edge, and you could have, probably generated some interesting investment returns doing that. Fast forward to today, and things have gone, in my opinion, the other extreme. Not only do we have, a lot of access to information, I'd argue we have access to too much information. So it's kind of an overload. You've got everything from newsletters to, financial news websites, and then more recently, as you alluded to, forums, social media, and a whole lot of other things. Okay. And it's a very good question. So how do you go about kind of filtering, the noise from kind of what's real or not? I think particularly as it pertains to, social media and forums where these posts are at the end of the day done by specific individuals, I think it's really worth kind of taking a step back and asking yourself, who is this particular individual and are they qualified, to be writing about investing, to give, almost like be giving financial advice these days, which is kind of blurring, the line between, regulated financial advice versus, people kind of writing things on, let's say, LinkedIn or on forums. So I think it's really worth kind of taking a step back, before accepting someone's, posts or opinions as face value, but trying to actually, dig into this particular person, look at their, previous posts, their track record and so on, and are they actually legit? And should I be trusting them or not? Okay, there's a big difference between, someone who has, 100,000 followers on TikTok because, they were posting funny videos and now suddenly they said, look, I'm going to start to talk about stocks, versus someone, on LinkedIn that maybe has only 1,000 followers, but, has been working in the investment industry for 20 years and is probably a lot more reputable. But I think probably the best thing you can do though is basically, arming yourself with the tools to try to filter out what is legit and what is not. And how do you do that? I think try to first of all rely on very objective sources of information. So I'm talking about, very reputable financial news websites, Bloomberg, Financial Times, Wall Street Journal, CNBC, etc., etc. Focus on those and then try to formulate your own opinions and your own views based on what you're reading. Okay, so go beyond kind of first level reading to what's called, second level reading. So instead of, just kind of reading it and reading an article and kind of taking a step back, read the article and ask yourself, okay, what are the market implications of this thing? So let's say you read a report that, inflation shot up higher than expected in the US. Okay, ask yourself after you read the article, what are the market implications? What does it mean relate to, how does this like flare up in inflation affect, interest rate cuts or hikes? What does that mean for the bond market, for the stock market, for gold, for crypto, whatever? So the more you kind of read the subjective news, the more you try to take things a step further, try to understand how this particular piece of news affects markets, affects the economy and so on, the more you're going to be arming yourself with the right knowledge to try to formulate your own opinions. And I think forming your own opinions is important, but also if you reach that kind of level of, proficiency, you can also use that to assess influencers, because you can start to filter out who is talking things that actually make sense and who is kind of saying things that are kind of lower quality, but perhaps clickbaity, trying to, gather a lot of impressions on their posts and so on.
Yeah, so many things to unpack there. Like, first of all, I love the second level thinking concept. So really trying to figure out the second derivative of everything you read and form a line of thought that makes sense to you and test it and challenge it by seeking contrarian views. And I mean, there's no secret. On my side, as a practitioner, I noticed that what helps is just doing it over and over again. Read something, think about it, share it with others, incorporate their other views, challenge your own views, pitch it, and start over. Not only that way, it will stick better within your mind, but also your whole story will become a lot more robust. And the other thing that you made me think about is when reading content online, particularly from social media and different creators, is what Ray Dalio defines in his Principles book as the believability concept, which is how credible this person is, really. So if someone is talking about ESG, probably someone that has 25 years as an ESG analyst has a lot more things to say, or is going to be more believable than someone that is just starting to look at the topic. That doesn't mean that there's big experts on certain areas just because it's a certain area of expertise for them and they don't necessarily work there or haven't spent as many years in the industry looking at it. But generally speaking, is a good shortcut, I would say, looking at that believability factor. And since we're touching on social media, obviously Reddit, Twitter have become primary sources of information for a lot of investors, particularly for retail investors. So yeah, if you had to single out like the one thing that you look in this type of creators as part of your research process to identify which ones are good from bad, what is it? Like years of experience, depth of the analysis, and second question related to that is, in which part of the research process do you incorporate all this information you consume in social media?
Yeah, I don't think, look, years of experience is definitely important, but I wouldn't say it's the single most important kind of factor. If you are basically looking at someone's particular posts, whether they're on a forum or LinkedIn or whatever, because you're relying on that information, I think it's worth really assessing the quality of that particular information. So within the post itself, ask yourself, does this line of reasoning make sense? Is it logical? Is it intuitive? And so on. And then why not cross-examine some previous posts that particular person has made in the past that can kind of, the interesting thing, or good or bad, but in the investing world, the stock market, etc., it kind of tells you after some time if you were right or wrong, right? So if someone, was making predictions for the past 2 years, hey, that the market is going to crash, and he's been making that prediction for 2 years and the market never crashed. And then you're like, okay, interesting, So you can kind of have a look at someone's, previous sort of posts and so on and try to kind of gauge things that way. But, bearing in mind that even the best investors in the world, a lot of times, to be honest, get things wrong, right? And the name of the game in investing is not to be correct 100% of the time, because that's impossible to achieve. The aim of the game is to be right more often than you're wrong. And when you're right, you make bigger gains versus smaller losses when you're wrong. So when you're wrong, swallow your pride, you exit the investment at a small loss. And then when you're right, you make a killing. So I think that's definitely the first thing. And then in terms of where to incorporate this in your investment process, I think that's a really good question, Ignacio, because personally for me, I view, social media, forums, newsletters, and so on as kind of lying in the very first step of the investment process, which is idea generation. So I find all these kind of tools and social media and forums and so on as a good way to get potential investment ideas that kind of get me excited. But something really, really key is you cannot go from that step. You read about some interesting stock someone's, touched on Reddit. You cannot go from there immediately to execution, where you just pull the trigger and buy the particular stock in question. There's a huge gap in the middle in the investment process that relies on your own research, on your own due diligence, that should never be skipped. No matter how good or reputable the particular person is that first posted that, you need to do your own research. So use these, online tools like forums, newsletters, LinkedIn, social media, and so on, as a good way to get potential investment ideas. But then what's super crucial is you take that particular idea and you dig into it yourself. You study it yourself, research it before you execute it. Perhaps halfway through that process, you figure out, actually, you know what? Maybe I don't agree with this person on that particular investment. And that's completely fine. There is no, full consensus. At the end of the day, you're going to come across investment ideas you disagree with. You're going to have particular investment ideas and investment thoughts that others are going to disagree with as well. But that's, again, the name of the game. I think that's something that makes investing really beautiful, is that you can have these very kind of constructive debates with other investment professionals. You can get challenged on your ideas and so on. And there is this no kind of universal consensus on a particular idea.
That's a really, really good point. Yeah, like talking about your whole investment process, like side comment as we're still on this whole social media part, but what are the steps that you follow as a research analyst from the idea generation phase that you just alluded to the actual implementation, the execution? What are the steps that our listeners should have in mind? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
It's a very good question, because if you ask me, Ignacio, what's the secret to investing? And in my humble opinion, it's having a good investment process and sticking to it. These are two separate things, but both are really crucial. A good investment process is one that's sound, well thought out, and makes sense and considers everything that needs to be considered, including the risks. Because a lot of people focus on potential upside, but not enough people pay attention to potential downside. But then the second tough part is sticking to it, because they say your worst enemy in investing is yourself, because your own behavioral biases, your own psychology takes over, and you start to, create these mistakes that basically don't allow you to stick to your investment process. So I think for me, what the process looks like, and it really depends on what I'm investing in, if it's a particular stock, if it's a high level ETF, if it's a commodity or whatever. But going from idea generation and then really trying to properly understand, let's say it's a stock, trying to properly understand the particular company in question. So I'm a fundamental analyst, like I'm a fundamental investor, like from the get-go. I don't purely trade based on charts or things like that. I like to understand the company in question. I try to formulate a particular investment thesis. So can I summarize in 3 points what are the main reasons why I think this particular investment is a particular stock is a good buy? I need to take some kind of view on valuation, because a great company doesn't necessarily mean it's a great investment, because you have to factor in what price you're paying for that particular company. And if you end up overpaying for a very good company, you're probably going to end up losing money, and vice versa. And then definitely need to consider the risks. So what could go wrong with this particular investment? Like I said, a lot of people, I think, overlook that. Everyone's trying to find, the next NVIDIA, but, people don't think too much about the downside, like what could potentially kind of go wrong. And then if all these kind of tick the box, I think the last part of the process is, trying to figure out how much to weight this particular investment in my portfolio. And that's really a function of two things: a function of how does this position relate to everything else in my portfolio. So for example, if my portfolio is heavily weighted in tech stocks and I'm about to add another tech stock, that tells me I should not invest heavily in this one because I'm being overly concentrated in a particular sector. And then the other function is my conviction level. So risk and conviction is ultimately what determines my investment position. So a very risky stock where I have low conviction about will have a super low weight in my portfolio, whereas a low risk stock where I have a lot of conviction on the thesis will probably have a much higher weight. And then you need to constantly, even after you pull the trigger and you invest, I think something that's really important is constantly testing your investment thesis. So if the news or the situation changes in that particular company and your investment thesis breaks down, let's say you bought it for XYZ, but XYZ are no longer valid. I think something that's really crucial is to basically swallow your pride, sell the stock in question, take the hit. That's much better than hanging on to it with the hope that it's going to recover at some point in the future.
Yeah, I think you said something at the beginning there is that really resonates with me, is that each person has their own process, right? And you need to find your way of doing things. Obviously, you can inspire yourself from others, but personally, I find that where I spend most of my time really is in the idea generation phase, because I like looking at markets, testing my hypotheses, seek contrarian views to avoid confirmation bias. And that's what I like to do. But again, each person is super different one from the other.
Absolutely. I think that's super crucial because remember I said good investment process and sticking to it. And the only way you can stick to your investment process if it's a process suited to you, to your personality, to your style of investing. If I try to force
comfortable with it, yeah.
Exactly. You need to be comfortable with it. If you happen to be a short-term day trader, that's because maybe that's kind of in line with your personality and that's what you're comfortable with. So be it. Focus on that and try to become really good at that. You cannot take someone like that and then try to enforce a long-term fundamental process on them because it's not their style. It's not what they resonate with. And if it's not something they resonate with, that means they're going to abandon it halfway through the process, which is a much worse outcome.
Especially when things get complicated and you start seeing a little bit of red in your portfolio. That's
Absolutely.
where you start getting nervous and challenging your beliefs.
And that's going to happen. There are always going to be days you're going to open up whatever tool you use and you're going to see a sea of red. Exactly. That's going to happen. That's guaranteed to happen in markets.
So yeah, this was kind of a side comment, but coming back to the social media part, like something that I wanted to highlight is the CFA Institute published a very interesting report about finfluencers and what retail investors should watch out for. And at the end of the report, there's some recommendations, and there's one I really agree with, which is that they say that regulators across the globe, financial regulators, should try to sit together around the table and coordinate some sort of set of rules for anyone wishing to publish financial content on social media, so that they are aware of what they are allowed to do and what not, because a lot of people are providing, for example, financial advice without even realizing it's illegal in most instances under that format. Yeah, I think there should be a little bit more coordination and transparency overall to have a healthier market, really. Something else that comes to mind, obviously talking about social media and retail investors, and specifically Reddit, is obviously the whole GameStop saga that happened at the end of 2020, early 2021, and the bouts of volatility. And a lot of people are arguing that the increasing participation of retail investors in markets is in some instances creating unnecessary volatility. And I wanted to ask you, do you see this increased participation as a temporary trend, or are we witnessing a fundamental change in how markets are going to continue operating in the future?
Yeah, absolutely. I think just quickly on your comment about, what the CFA Institute is saying, I think that's really, something I advocate for, because there has to be some kind of global framework, because at the end of the day, social media posts, forum posts are global, right? Your LinkedIn posts, Ignacio, are being read all over the world. And I think that's something really key for people who are posting on social media, etc., especially if they're blurring the lines between, financial advice and opinion. So I'm looking forward to some kind of framework like that. I'm also looking forward to, having people disclose a position in a particular, let's say, stock or something that they own if they're posting about it. I think that's something also, that everyone should really be doing. So if you're writing something, a forum post or LinkedIn post about a particular investment and you own it, I think that's, something really people should be flagging, at the very least from an ethical point of view. Because there's obviously a conflict of interest there, right? If you own a particular investment, you want to paint that investment in the best light possible, because the hope is, other people buy it and then it can kind of increase the value of the investment and benefit you. So going to the meme stock mania. I think, I think things kind of went, spiked and then dipped and kind of remained sort of as they are. So we're at a higher level compared to, 2020, but we've definitely come down from the peak that we saw in 2021. I think you gotta, look back and try to ask yourself, how did this happen in the first place? And a lot of it is related to the pandemic. So people were locked up at home, bored, in many cases out of a job, and wanted some kind of way to pass the time and perhaps make some money because, they lost their jobs. Plus, they were given a lot of, government stimulus checks. They felt like, hey, let me just take this money and try to play around with in the market. And then you saw that massive kind of spike, obviously, that happened with, GameStop and a whole bunch of other names. But now, as we stand now, retail participation in the market, like from a volume perspective, is definitely higher than before the pandemic, but it has definitely come down from the highs we saw at the peak of the mania. Personally, I am very in favor of access and retail participation in markets if it's done sensibly. And if more retail investors are participating in the market and that leads to some higher volatility, why should we stop that? In the stock market, people understand the risks of the stock market. And part of the risk is that it's volatile. I don't think if, more people investing in it and it suddenly leads to the stock market becoming a little bit more volatile, that's something we should try to fix. At the end of the day, the stock market is there offering you the potential for higher long-term returns to compensate you for the fact that it's volatile and it's risky. If you didn't want volatility, go play in the money market funds, right? Go play in that market. Cash, safe, you generate low interest. So I don't think personally higher volatility is something we should kind of try to fix because, more retail investors are suddenly investing in the stock market. To me, that's not a particular issue. I think if you have, things are, like a bunch of retail investors kind of ganging up and then trying to, manipulate the market in a certain way, then I think that's a whole kind of different issue. I think generally speaking, more people are now investing in the stock market and the stock market becomes, a bit more volatile. So be it. I think also kind of last thing related to this is, does it impact, market efficiency? And there are two ways I can see this going. So what I mean by market efficiency, for those who don't know, is, do the prices, the underlying prices of, the stocks and so on, do they reflect the underlying fundamentals? So a perfectly efficient market is one where, stock prices always fully reflect, fundamental information. And inefficient market is one where you have a lot of misprices. So I think one question I'm kind of asking myself, and I don't know the answer to this, maybe Ignacio, is does increased retail participation lead to more market efficiency or inefficiency? And this can kind of go two ways. I think on one hand, if you have a lot more people participating in the market, looking for underpriced stocks to buy or overpriced stocks to short, or at the very least to avoid, there's an argument to be made that perhaps that increases market efficiency because now you have more and more investors looking at the market, looking at stocks, buying things they think are undervalued, selling things they think
better
are
price
overvalued.
discovery and so on.
Better price discovery and so on. On the other hand, there's an argument to be made that if this influx of retail investors are not fully informed and are not, acting rationally, then perhaps that leads to more inefficient markets. And historically speaking, just looking at what happened with GameStop, you can argue that that was an example of an inefficient market because there's no way GameStop was fundamentally priced at $2 and suddenly was correctly priced at $100 only to fall back to kind of $30, right? So that was kind of an example of a big, perhaps, inefficiency that happened in a short matter of time. So I don't know how this is going to go in the future. I think as more retail investors kind of participate, and if we, me, you, and other people in the finance industry do our job properly to kind of educate people on how to invest properly, then perhaps that leads the market to becoming more efficient over time. But the jury's out and we won't know just yet.
I tend to be in camp number one, probably. I think the larger the number of market participants, informed investors at least, no matter what their views are, because obviously, there's people that are always going to have more bearish views and some more bullish views. But as long as, there's more participants doing, informed decisions, I think that's a sign of a healthier market. The problem I have, though, is when there's investors that are not really investing, but are gambling. And I think that raises a whole different set of questions into the equation, which are the ethical concerns of mainly the fintech platforms and the trading platforms and the access that they've created for many of these investors. As you know, there's been a lot of debates around the gamification of investing and how some platforms have encouraged excessive risk taking amongst inexperienced investors. And obviously the whole confetti animation thing comes into mind here. So I guess my question is specifically, what do you think of confettis in trading applications, Reda? And more broadly and more seriously, do you think investing platforms have a moral responsibility to discourage risky behavior amongst retail investors, or not at all?
Yeah. So to answer your two questions quickly, I hate the confetti. And I think definitely think trading platforms have a moral responsibility to protect their clients. Look, I hate the gamification of investing and trading. I don't think it should be like that at all. I think, like, what are you trying to do at the end of the day? As a broker, you're trying to encourage people to trade more because that benefits you. Does it benefit them? No, it doesn't, right? There are so many studies out there, academic studies out there, that show excessive trading leads to worse investment outcomes. Even if you are trading with a broker that doesn't charge you commissions per trade, you are still implicitly paying a little bit of a fee just by virtue of the bid-ask spread, okay? That's when you basically buy something at a higher price than you sell it for when you're dealing with a particular market. Just think about when you go to your foreign exchange shop and you want to exchange dollars to euros, right? They always have two prices printed. And you want to buy euros, you will always buy euros at a higher price than what you will sell it to them, right? To your local currency shop. It's the exact same thing in the stock market. There's a bid-ask spread, they call it. And this spread becomes more pronounced the smaller the stock and the less liquid or the less frequently the stock trades, okay? So implicitly, you're paying a little bit of a cost. Even if you're trading with a commission-free broker, you're still paying a little bit through the bid-ask spread every time you trade a stock. I think the other bigger, wider problem is the more you trade, the more prone you're going to be to making behavioral mistakes, So if you're trying to day trade, you're trying to buy something at the low and sell at the high, you're essentially trying to time the market. That's impossible. It's impossible to time the market. It's extremely difficult. Even the best investors can't do it. And one of my favorite sayings is, time in the market beats timing the market. So don't try to time the market. Don't try to day trade and try to buy on the day's low and sell on the high and so on. Build yourself a sensible, diversified portfolio and just keep on holding it for a very, very long time. You don't need to trade so frequently. Maybe rebalance it once a month, once a quarter, or something like that. But you surely do not need confetti to try to encourage you to trade that portfolio unnecessarily. And do they have a moral responsibility? Absolutely. I don't think you should be encouraging excessive trading because it's a fact. Excessive trading leads to worse investment outcomes. So if you genuinely have your client's interest at heart and not your own business interest at heart, you should not be encouraging excessive trading.
So I have a mixed feeling about this one. I kind of agree and disagree with you. So I 100% agree with the fact that investing is not a game. I think we should all agree on that. It's very serious. We shouldn't be gambling with our or other people's money. Now, what I find these platforms did, which I kind of agree with, is they did simplify the investment process and the whole journey. Because as you said at the beginning, with information, we came from a world where information was barely accessible to a world where it's democratized. And trading is the same. Like a few years ago, it was close to impossible, as a retail investor to do the things we can do today, especially if you wanted to get into a little bit more complex asset classes and so on. And I think that's part of a healthier market, having broader access and simplifying the rules of the game in order to be able to operate. Now, of course, I think in some instances this has been overdone, and some investors have lost sight indeed with all this gamification of what trading and investing is really about, and the dangers associated with it, right? Because that's the thing, when you think it's a game, you think there's no real consequences, but there's very real consequences. And there's been some tragic stories of people losing their life savings and so on. And that's where I have a problem. So, yeah, 100% in for making things a little bit easier, modernize platforms and increasing the access and so on, but definitely not on making it look trivial.
You can do things. I think, you can do certain things that, that you don't have to reward every time someone does a trade. For example, let's say someone opens up a platform and they buy their very first stock. They buy whatever it is. Okay, show them a little confetti. Congratulations, you have officially bought the first stock. Like, you are now a stock investor. But then that's it. Like, you don't have to keep on giving them confetti and champagne, virtual champagne emojis every time they do a trade, because I think that's taking things too far. I think buying your first stock, in my opinion, that is a nice achievement. It's a nice feeling. I remember the first time I bought my first stock, I was like,
your
okay,
heart
wow.
is beating as if you were about to change your whole life, even if it's for $5, right?
I think $3 at the time, but yeah. But you know what I mean? Something like that, I can understand, I can agree with. Or perhaps if you want people to participate, some platforms, they do this thing where, you buy something on your bank card, they round up to the nearest dollar, and then they automatically invest that in an ETF. I think something like that is sensible, because you're encouraging people to just, in small amounts, add gradually to an ETF that tracks a broad market and to kind of hold on to it. I think, to me, something like that is a lot more sensible. So you can still do things. I'm not against, making things more fun, because, you're not going to stick to investing if you're going to find it extremely, extremely boring. You do need some element of fun. And that's something I really enjoy about investing, because I get to learn a lot about different industries, different technologies and things like that. And that really excites me. I think there should be an element of fun in investing, but I think, just the degree of which and trying to, incentivize excessive trading, I don't think that's something I personally agree with.
Yeah. So obviously, these platforms, these modern trading platforms, have been able to come into existence thanks to the development of tech. So I'd like to spend now a bit of time talking about tech and particularly about AI, which I think it's a topic that is very close to both of our hearts. So my first question is, we've seen a proliferation of AI tools to assist you in the investment journey. How do you think retail investors are using these tools at the moment, and how do you think they should be using it when it comes to their investing journey? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
So it's hard to say how retail investors are currently using it. I mean, I don't have some kind of, informational edge on how people are using these AI tools with their investing. I have seen a lot of anecdotes and so on. But in terms of how they should be using, of course, I have a view there. I think with any exciting new technology, I think you should really put a conscious effort to try to learn how to use it, especially something as, fundamental as AI. And like, you hear these, anecdotes of people where their jobs are a bit at risk because of AI. And then they have this kind of personal vendetta against the technology, and no, I'm going to refuse to learn AI. I think that's a very wrong approach, from a career perspective and a wider kind of life perspective. I think if there's a big technological disruption happening, I think you should really put a conscious effort to try to learn. Okay. At the end of the day, AI it will, replace some jobs, but I think for the vast majority of jobs is going to be there as a tool to try to make you better and more efficient in your job. And that could be your professional job or in investing, as we're talking about today, Ignacio. And that's what I view AI as, a really good tool to help make your investment life easier. again, going back to that thing I was describing earlier, where you had idea generation from social media, newsletters, and so on. And then at the very far right, you have execution. And then you have this huge kind of process in between, which is conducting your own research. I think now the beauty about AI is that, what used to take you perhaps a really large amounts of time can now be shortened quite a lot. It will still take you time, but you can shorten that amount. For example, very easy use case, right? If you're considering investing in a stock, I think you should spend a lot of time reading the annual report, because the annual report tells you what the business does. Management literally risks all the risks that, could face the company. There's the management discussion that tell you why revenues went up, why profit margins went down, et cetera, et cetera. And you should be spending a lot of time reading that. But now you can just go to an AI tool, upload the PDF, and start to have a chat. You can summarize the company's business model, summarize the key risks, et cetera, et cetera. So it's a really
and
great
it's so
way.
easy to do, right?
It's
honestly,
so easy.
In ChatGPT, it takes you literally 5 seconds to do that.
Absolutely. And I think to me, that's where the power of AI comes in. Its ability to do things maybe not to perfection or to the level of a human, but it can do a wide range of tasks much quicker than a human. Speed. And if you're going, from this idea generation stage, it's like a filtering process. Not every single idea is going to end up in execution, but if you have 10 potential ideas, it's going to take you a lot of time to research 10 different investments if you didn't have AI. But suddenly, if you have AI, you can use this as a really powerful tool to do quick research, gain quick understanding of the different kind of potential investments. And then you shorten that maybe to 2, and then you can start to do more in-depth. So I'm all for using AI. It's a great tool. It's there to make your life easier. It's your intern. It's your own personal intern at the end of the day.
A team of interns.
And very cheaply. What is it? $20 a month for the paid version. The medium tier now. Chad, it's the cheapest intern you're ever gonna hire. You might as well use it. And I think people should be using it. There are many different ways to use it. I've written a lot about this. Finimize. You can use it to summarize financial statements. You can use it to conduct a SWOT analysis on particular companies. You can use it to backtest certain trading signals on the particular stock price, for example, understand the competitors. There's no limit to how you can use it. The only limit is your creativity.
Yeah, I remember you had a viral post on LinkedIn, you or one of your colleagues in Finimize, a year ago, where you were explaining how to use ChatGPT for
that was me.
It was you, right? That was really cool. So, you and I have talked about this in the past and our concerns about how fast AI is moving and the dangers it represents for our jobs. Obviously, you spend a lot of time writing content, generating content that, all these tools are now making a lot easier to do. On my side, I'm a fixed income advisor, and I do see the potential for a lot of my day-to-day tasks to get automated to a certain extent in upcoming years. So I guess my question for you is will Reda and Ignacio of the future survive in this future, and what will our role be in the financial industry 5, 10, 20 years down the road?
Wow, didn't think about it till you asked me, Ignacio. I don't know. I think it was Bill Gates that once famously said, people overestimate in the short run a technology's disruption, but underestimate its potential in the long run. So in the sense that perhaps people are overly excited now and so on, but then kind of taking the internet example, when you had the .com bubble, everyone was extremely excited and the whole thing collapsed. But then in the long run, the internet completely changed our lives, right? I think something similar could be happening with AI at the moment, where maybe we are underestimating its long run potential. This technology has been out for just over 2-3 years now, and already the rate of change that we've seen is phenomenal. Is it at a stage now where it can do my job? No. And I'm not trying to say I'm great at my job. It's the simple truth is, I've tried to replicate it to do, my job. I tried to create a Reda GPT, and it wasn't there. 10 years from now, maybe you can take over the written content that you and I do, Ignacio, but can it really take over the intuitive thinking, critical thinking that you and I do about markets, the making the connections? I think time will tell. I think AI is really good, at doing kind of, specialized tasks. But I think one thing, and that's the distinction people are making between AI and artificial general intelligence. Because AI at the moment, if you think about it, is really good at doing specific tasks. But the end goal of AI, and this is OpenAI's mission, is to create artificial general intelligence, where it's not just really good at certain things, it's really good at everything. I think that's what differentiates humans between AI at the moment, is that we're good at many different things. We can make those connections, which is really important in the context of markets and investing, because nothing is isolated in investing. Like, even me, when I spent 4 years as an equity analyst, as a stock analyst, I made it a point to understand what's happening in the bond market, what's happening in commodities and so on, because everything is interconnected. I used to look at utility stocks, because they pay high dividend yields. People think of them as bonds. So bond yields used to impact utility stocks. I had to understand the bond market. Because these utilities burn natural gas to generate power, I had to understand the natural gas market and commodities. So I guess what I'm trying to say is everything is interconnected, and that's something we do well in the industry because we've been looking at markets for a very long time. That at the moment is hard to replicate with AI. To answer your question, in 10 years, what will our role be? I honestly don't have an answer, Ignacio. Where do you think we will be in 10 years?
I have a great answer to that question, actually. So, first of all, I'm an optimist about AI. I tend to look at life glass half full, so I see everything as an opportunity. That's my disclaimer. So there is a book, I think the author is Peter Covey, and the name of the book is Humans Are Underrated. And there's a theory in there which says that, an anecdote which explains that the best chess player ever, I'm not a chess player, but I read that in the book. So the best chess player is not a human and is not a machine. Apparently, it's what it's called in the chess world as a centaur. And a centaur is a group of humans that have the support of several machines. And apparently, that's the best chess player that has ever existed. If I'm making this up, by the way, or someone disagrees after listening to the podcast that knows all about chess, please let me know, because I did read this in the book. And it really resonated with me, and I realized, oh my God, maybe we're going to become centers in the future. Maybe the best financial advisor in the future is not going to be a human. It's not going to be a machine. It's going to be a human counting with the support of a very strong machine. And maybe Ignacio in the future, instead of being just Ignacio, fixed income advisor, looking at credit and rates and bond markets all day long, I'm going to be able to do what I do for bonds, but across all asset classes, and produce much higher quality output and much more quantity too. The way I see it is, these tools, if we are proactive and we do things right and educate ourselves, are going to empower us to become the best version of ourselves. And there is also a sentence I love related to all of these, which says, AI won't replace you, but someone using AI will. And I
absolutely.
I think that's 100% true, because you just can't compete. Like, I agree with you with the fact that a lot of AI tools are still not there yet. But first of all, things are moving super fast. So you're literally seeing progress from 1 week to another. And secondly, there are already some really good tools like ChatGPT and so on that do help and provide a lot of value added already. And I've seen it first eye. You just can't compete. You can upload a prospectus on ChatGPT or the annual reports, as you were saying, ask specific questions, and you're going to get fairly good answers in seconds. And that job would take you minutes or hours if you had to do it yourself. So I'm excited. It's a little bit scary, I know, but I'm an optimist, and I want to be excited. I think if we take time to educate ourselves, we're going to become a better versions of ourselves and better professionals. And and I can't wait to see this whole revolution happening, honestly.
Do you remember, Ignacio, a discussion we were having a few months ago about this, actually? And I told you, because you and I were analysts, but we're also content creators. because, I produce content, Finimize, you're producing content on LinkedIn and so on. And I was telling you, I don't know the answer to this, but the philosophical question is, with AI now generating so much content, so anyone can now open an investing blog and ask ChatGPT to write blog posts and post them online. What is a stock? What is a bond? What is whatever? And I was asking you, do you think, this dilutes the value of content just by virtue of having a massive explosion in volume? Or does that increase the value of really good, differentiated, well-researched, thoughtful content? Because in this sea of AI-generated content, are we that massive tuna fish that sells for $1 million in a, Tokyo fish market? Because, you can suddenly create really differentiated content and kind of stand out from all this AI generated content. Again, I don't know the answer to that, but I think if you do want to create, content that stands out, you at the very least need to be using AI, because AI can help you improve at the end of the day your content, your writing. You can use it for editing. You can use it to research ideas, or let's say I'm writing a piece, like 3 reasons why, something like that. I can ask ChatGPT, okay, give me all the reasons you think of. And I'm like, oh, actually, wait, I overlooked this one, So it's a tool, it's a companion to help make your life better and easier and more efficient. And I think everyone should be using it one way or another.
100%. Amen to that. So I want to go away now from technology. I want to go away from retail investing. We have time for a couple more questions. So I want to go back to you, actually, and your career. And I have 2 questions. So my first question is related to the CFA. You're a CFA charter holder. A lot of our listeners, I'm guessing, are either in the process of becoming a CFA charter holder or thinking about it. Obviously, huge time commitment. The unofficial rule says that it's around 300 hours per level. And I wanted to ask you, in all honesty, is it worth it? And has it helped you in your career to be a charter holder?
So for me, my situation is a little bit unique because I basically did my major during my undergraduate degree in finance. And then I did a master's in finance. And then I did the CFA. What I mean to say by that is by the time I came to do the CFA, I actually knew a lot of the material already. So from an incremental learning perspective, I still learned. I think one thing the CFA does well is that it's quite broad in the sense that you learn a lot, not just about stocks, but you learn about fixed income, you learn about commodities. I think recently they included crypto. Correct me if I'm wrong.
I think so, yeah.
Yeah, and then you learn about investment management and so on and so on. So, and again, I think having, especially when it comes to markets and investing, I think having that kind of breadth, even if you just have high level understanding of different markets, I think that's really, really important because markets are all intertwined. Incremental knowledge that I gained, I still gained some, but wasn't huge considering I've already done a bachelor's and a master's in finance. I think CFA becomes, more like a signaling tool. You get those 3 letters, you add them at the end of your name. And then when you're applying for jobs, it definitely helps because it signals that, A, you understand finance because, hopefully you do after 300 times 3, 900 hours of studying finance. I really hope you what did they say? 1,000 hours to become a pro
it's so 10,000.
10,000. Okay. Well, you're way off then. No. Okay.
But you're good. Well on the way.
You're on track. You're 10% there. So you kind of signal that A, you understand finance. B, you're dedicated because I don't think the CFA personally is hard in terms of the material itself. It's not like you're doing stochastic calculus, which I had to do on my master's. But I think it just requires a lot of willpower and a lot of commitment to sit down and study it. So I think that's something else you signal to employers that, hey, look, I'm dedicated. I can sit down, put my head down and get work done. Does it help? I think it depends what you want to do in this industry. I think if you're just trying to become a better investor and you don't necessarily want to work in this industry professionally, I definitely don't think you need to do a CFA. You've got lots of learning materials freely available online and lots of good people you can learn from, online courses and so on. If you want to work in the industry, I think it kind of depends what you want to do. I think I get this question a lot from some of the students that invest in New Academy that we see. People are interested in joining the sell side, they want to join investment banking. And I tell them, to be honest, there's probably no point in doing a CFA because the CFA is really tailored more towards the buy side of things. People who want to work, at investment firms, hedge funds, private wealth managers, and so on and so on. And if you do want to work in those areas, I definitely do think it helps. Has its relevance gone down over time? I argue yes. But in absolute terms, does it help? Yes. Even if it doesn't change the odds of your application being read, at the very least, you learn. You learn by doing the CFA. So just having that knowledge already gives you an edge if you go to an interview.
Yeah, I tend to agree with you. I mean, I come from the premise that investing in education pays the best interest, and it's a lot of work, but you do learn a lot. So on my side, I didn't study finance specifically. I did business, so I did cover a fair amount of stuff from the level one. But what I enjoyed about the CFA, despite the fact that it's a long journey and it's painful, is the amount of things you learn, and it's stuff that stays on the back of your mind. So obviously, if someone asks me to do the calculation manually on a piece of paper on the pricing of an interest rate swap, I would say, gosh, I don't remember that. But I know I did study that kind of stuff in my CFA. I can go back to the materials and I'm like, oh yeah, this is it, and I'm not completely lost anymore. So in that sense, I really liked it. And secondly, I think being a CFA doesn't mean, it doesn't mean that you're a better investor or that you're going to be more successful in finance. But I do think it signals, at least for people that don't know you, that you have work discipline and grit, because it takes a lot of effort to do it. Whenever you see those three letters, CFA on a CV, you know already that person is hardworking, because you don't get the CFA by coincidence. That doesn't happen.
Like I said, I don't think the material itself is necessarily difficult. I think what the CFA at the end of the day requires is a lot of dedication and grit, like forcing yourself to lock yourself up on a weekend to just study.
Yeah. I'm prouder of my CFA than my master's degree. I have 2 master's degrees actually. And yeah, but the reason for that is that when I got my master's, I was a full-time student and I had all my day to go to the library and go to class and hang out with my friends. And the CFA, I had to do it in the evenings while I was working full-time in finance. And that's not the same thing. When you get home at 9, have dinner and have to sit down at 10 in the evening for a couple of hours for 3 years, because at the time you could only take the exam once a year. Man, I mean, that was tough. Like I don't even know how I did that.
Yeah. I fully agree. I had to do exactly the same. So I did it in 2 years, because you could do the level 1 in December, if you remember. I did 2 in June and then 3 the next kind of June. And yeah, those 2 years were miserable, to your point. Like literally my first proper job in London and coming back home.
But it helps you to appreciate life. Once you're done with it, you're like, oh my God, look at all this free time I have. So one last question for you, a bit more philosophical, but I want to ask you, I mean, you have 12 years in the industry already, hopefully many, many more to come. But I'd like you to share maybe a valuable insight with our listeners. What's one lesson that you've learned in your career, in your finance careers, that you think could help our listeners in their finance career? What's something that you would like to share with them, a piece of advice, a tip, or just something in general that you think could be of use?
I'll give maybe 2. One is career related and maybe one is investing related, because the 2 are intertwined, right? I have a investing career at the end of the day. I think the career one, if I had to give one kind of top tip, is something maybe I underappreciated in the past, but now I'm realizing is essential, and it's probably going to be even more essential in an age of AI, is the importance of soft skills. The importance of communication, the importance of, teamwork, expressing yourself, expressing your ideas, and so on. And like a very good example I gave, like that actually happened to me, is being an equity analyst at Fidelity. And people think equity analysts sit down on their desk all day, researching companies, reading annual reports, building complicated discounted cash flow models and so on, and then their day is over. That was half the job. Like once I did that and I concluded a particular stock was a good investment, Then the real job started, which is trying to convince my portfolio managers to actually buy it. Storytelling. I literally, because, at Fidelity, I had many portfolio managers to report to. So I would literally have to walk the desks and like sit down with them and tell you, okay, guys, I think this is a really interesting, stock idea, investment idea. Let me tell you why, and so on and so on and so on. And there's a big aspect of communication, pitching, debating involved, and not even just kind of, doing it to my portfolio managers, but even, we had the privilege at Fidelity to meet the management teams of the companies we invested in. So I would run those meetings and, you'd ask them questions and so on. Part of the information you'd gather is what they're telling you, but part of it was their body language, Yeah, we're going to hit guidance next quarter or something like that, like just the way they would talk about their industry or something like that. Their body language can kind of reveal a lot about like, are they actually have a positive outlook, negative outlook, etc. So, but what is that? That comes down to kind of reading and trying to understand humans at the end of the day. I think the importance of soft skills, communication, dealing with people, debating, resolving conflicts, and so on, is something really underappreciated in the finance industry. People think we're these nerds that just construct Excel models all day, but there's a big aspect of communication, especially if you work in client-facing roles. Let's say you're a financial advisor. Even if you're a portfolio manager, you still have to, deal with the clients who are investing in your funds and so on. I think that's a really underappreciated skill, especially in the age of AI, because that's soft skills is what differentiates humans between AI. One of the things that differentiates. And I think the second kind of lesson on investing is a really, really simple one. Something, 12 years, more years investing in the markets because I started before I started my career, but just keep things simple. Like start young and early. Because of the power of compound interest and compounding returns, the earlier you start your investment journey, the better off you're going to be when you retire, for example. So just start now with what you have and keep things simple. Buy an ETF that tracks global stocks, buy an ETF that tracks global bonds, adjust the mix based on your kind of risk tolerance, and just hold it. Keep things simple. Start now, harness the power of compound interest, which Albert Einstein famously called the eighth wonder of the world. Keep things simple. And honestly, you're going to be better off than a lot of people who try to select their own stocks, try to select the hottest thematic ETFs, try to day trade. I bet you if you just do these things and keep it simple, you're going to beat the vast majority of people who are trying to be very clever with their investments. Investing doesn't have to be overly complicated. Honestly, simple things lead to very adequate and good outcomes.
You're talking to a fixed income guy, so the compounding idea is music to my ears. I love how we got two for the price of one there. Thanks for sharing those tips. Reda, it's been an absolute pleasure to have you on the show. I think you've shared many, many gold nuggets there. For those of you that, again, didn't know Reda before, make sure to check him on socials and his work on Finimize. And Reda, thank you so much for being on the show. And hope to see you very soon again over here.
Been an absolute pleasure. Really enjoyed that, Ignacio. Thank you so much. And maybe I'll be back and we'll have some more interesting discussions.
My God, I forgot to press the record button again, Reda.
You're joking. I can see your report.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.